Alrighty, and we are live. Hey, what's up, everybody? Welcome to the MLO show. I'm Abel Perez.
And I'm Stephanie Perez.
And we are the Married Loan Officers.
Officers.
Man, we're getting good at that.
I feel like we should the Married Loan Officers.
Yeah, we'll figure it out. We'll figure it out.
Okay, gotta work
In the
on
meantime, we need you
tone
guys to like and subscribe because we want you to like and subscribe. And all the people that do YouTube always say, and smash that bell. So we're going to tell people to smash that bell, please.
Click on it, tap on it.
Well, Steph, we took a week off.
We did.
And we apologize to all you viewers. We know that you were anxiously waiting by your computers, by your tablets, by your phones to watch us live.
Yeah.
But unfortunately, we did experience a loss in the family. Mm-hmm. And so we attended the services, beautiful services for a beautiful woman who lived a very beautiful life.
Yes.
And so we appreciate your understanding for us missing that last week. But anyway, we're back in action here, Steph. And what do we got going on?
The events from last week sparked conversation for this week. So our topic, we are going to be going over beneficiary deeds, and then we'll get into some rates after that.
Okay. Whenever you're ready.
Okay. So Abel.
Yeah.
No, actually it goes into our real buyer scenario that you had just this last week. So I guess we'll start with, what is a beneficiary deed?
Yeah, well, let's go back to what a deed is, right? Ownership of a property, holding title, as it's often referred as. But if you are on a deed, that means you do have official ownership of that property, right? And, the real buyer scenario that had come up was client taking his application. I asked the question that's on the 1003 application, right? You asked, do you have any ownership in any property in the last 3 years? Mm-hmm. With confidence, they said no, so we moved on, right? Okay. We get into contract, we get into escrow, and on this in particular contract, we moved forward with a loan program, a conventional loan with a 97% LTV, meaning they only had to come down with 3% down. But that type of program is reserved for a first-time home buyer. Yeah. So we thought, okay, no brainer. These guys are first-time home buyers. They qualify. DU approval. Everything's beautiful, right? Well, during the process of running our loan safe reports, we found out that he is, public record. All deeds are public records. This individual's name came up as having ownership of a property. So from there, we asked, hey, here's his address. Do you have any ownership? And he said, oh, no, that's my parents' house, right? I grew up in that house. Very common, right? Mom and dad still living in the house that you grew up in. But why are you on the deed, right? And so,
why are you an owner of this property?
Here we are in 2013, and he's like, oh, yeah, I recall back in 2005, my parents, were concerned about their health and thinking, we want to be prepared in the case that something happens to us. And so let's add you to the deed. And so that if we pass, you automatically take over because you're the sole owner at that point, right? Mm. And so this is very common. This is, common for a lot of families who maybe don't have friends who, can tell them about how wills and trusts and all those things work, after death. How do you leave assets behind? And so this was, for this family, the best that they knew of and the best that they could do. Well, perfectly fine. There's essentially nothing wrong with that until this individual, who's the child in this sense, we're a grown man now, but their child wants to buy a house and wants to buy a house using a loan program that requires first-time home buyers, right? And so even though he didn't, wasn't responsible for, didn't live there anymore, hadn't lived there in, 10, 15 years, there was not even a mortgage on the home. He never applied for a house prior to this. And he's like, dude, I'm not a first-time home buyer. And it's pretty obvious to see. I mean, he is a first-time home buyer, right? It's pretty obvious to see that he legitimately is, right? But with the rules and the way HUD defines a first-time home buyer, he's technically not, right?
Yeah, and so if he were truly a first-time home buyer, what are the benefits?
Yeah, so like I mentioned, we would have been able to move forward with that loan program, which was a conventional loan with only 3% down, right? Mm-hmm. And there are several other types of down payment assistance programs that have that requirement, like if you use this program, you have to be a first-time home buyer, right? And so he would have been ineligible for those type of programs if we were pursuing them, right? So between between down payment assistance programs that, allow you to have, as little as 3% down. Those type of programs no longer become available if you're in that situation, right? So then the big question is like, okay, so what can somebody do? And you had mentioned it earlier, it's the beneficiary deed. That is an option, right? And the beneficiary deed, what that is you are signing somebody onto the deed, but they aren't actually officially on the deed or don't have legal ownership of the house until the current owner passes away, right? Until the grantor passes away. And so the reason why this is, kind of a cool option is because it's relatively cheap. You download the form or you go over to your county recorder's office and you get the form from them and you contact a notary, and that notary is going to charge you maybe a $50 or $75 fee to get this completed, right? And so once you have this in place, once, let's say it's your parents, once your parents pass away or your parent passes away, you would take their death certificate down to the recorder's office and you would show that they've passed away, and then they would go through the process of adding you to that deed, right? So it's a very affordable option, and certainly a better option than let's say doing it the first way, right? Because then you restrict whoever you're adding from being a first-time home buyer. So obviously, consult somebody who does life planning, somebody who can maybe construct a will for you or put a property in a trust. Those are some better options, but with better sometimes comes more expenses, right? So that might be a less affordable option, but certainly the technical and legal way that it should be gone about. But bottom line is there are opportunities like the beneficiary deed form that can be completed that might solve that problem.
Yeah, so, and preserve the first-time homebuyer status.
Yep.
Sure. So now, can you go over kind of what your solution was for this particular client?
Oh yeah, so obviously that's kind of a problem, right? And what happens, right? Because these people went into contract with the expectation of only coming in with 3% down, and now technically, if they're going to remain in a conventional loan, they're going to have to put 5% down, right? Yeah. And so that's 2% down more than what they anticipated, which is a couple $1,000s. So very fortunately, we were able to, the realtor on this case was able to negotiate seller credit to offset that. That's good. And they were actually pretty pleased with between the seller credit and then their terms improving, because anytime you go from one LTV to a lower LTV, your rates are much more healthy, right? So 97% versus 95%, you have a little bit more skin in the game. You start off with a little bit more equity. So the banks are going to reward you with a healthier interest rate. So, yeah. Nice.
And speaking of interest rates, I know that's always the big question, right? What are interest rates doing?
Where are interest rates? Yeah. The market in general is becoming a little bit more active. And interest rates for the majority of 2022 were the culprit of why the activity was so slow, right? A lot of people were hesitant. A lot of people were nervous. The 6-7% interest rates really scared people, right? And rightfully so, because those interest rates correlate to what your monthly payment's going to be. Higher the interest rate, higher your monthly payment, right? So people were like, let me just kind of wait this out. Now interest rates are starting to ease their way back down, right? We're seeing rates very commonly in the low 6s, mid to high 5s, and buy down options as in the mid 4s, right? And so whether you're buying down using discount points to buy down your rate on a 30-year fix, or you're using great options like the 3-2-1 buy down or the 2-1 buy down. Those we've talked about those on this episode. Yeah. Mm-hmm. Great options to get yourself through the first few years in order to get yourself through the first few years of homeownership with the lower payment. Wait out kind of the economy and get rates to come back down, refinance and recapture that lower interest rate long term. Yeah. And recently, so in 2007, 2008, we all know about the housing crisis and what that kind of did, right? And a lot of that is attributed to poor lending practices where there was not a whole lot of regulation, right? Yeah. And there was a loan program in particular called, do you know what it is?
Wait. The move back
The
and
arm.
forth and fluctuate
it's
up
actually,
and down.
It's actually the ARM rate, right?
Oh, yeah.
The adjustable rate mortgage.
Well,
So
like you're making a motion. I think
it
if
was
you were
like,
just like
I didn't want to anyway.
you know,
Okay. Well, I'm not very good at Simon Says or what's it called?
raise the
Pictionary
roof
or charades.
No,
Maybe
you're
I'm not good
definitely
at
not.
charades,
He's definitely not good at
but I do know a little bit about lending and financing. So let's dive back in.
Okay.
So back then, the ARM rate was a popular rate, right? Because it was like, hey, let's lock you in. Well, you'll have a 2% interest rate, and all will be well. And later on, you could refinance and get out of that. Once the rate starts getting too high. Well, the terms behind those were not properly disclosed. People weren't properly qualified for those type of mortgages. So a lot of people fled away. And so to this day, when people hear adjustable rate mortgage, they freak out. They're like, oh, you know what? That's not for me. I heard all the horror stories. I've had family, friends, or maybe even themselves who have had to lose homes thanks to those type of loan programs, right? However, lending practices have since strictened. There's a lot that has been taken into consideration, and a lot of layers of protection for consumers have been implemented to prevent people from not being qualified for worst case scenario, right?
Yeah.
And so with that, we do have a 30-year it's a 30-year mortgage still, but the first 10 years are fixed. After once year 11, between year 11 and year 30, it now becomes adjustable, right? But with that type of loan program, we're seeing rates almost an entire percent cheaper than what the 30-year fix would be. And so literally going from 5.75 to a 4.75, that's saving people $250 in some cases, depending on the purchase price. And so these type of solutions are reinstalling confidence in consumers, getting people re-engaged in the real estate market, and you're seeing houses starting to fly off the market again. And meanwhile, you have all these people who are like, I'm still waiting, right?
No, don't do that.
That's a strategy that is used by the majority. And anytime something's used by the majority, right, it's probably not a secret, right, or no longer considered a niche strategy.
Yeah.
Because what's going to happen is, if you're not engaged now in the market when things are still kind of simmering, they're starting to get hot again, but they're still at a simmer. Once things get hot, that means that the floodgates open. Everybody who had the same strategy of waiting for the market to cool off, and now they want to jump
Now
in there and buy their houses.
The gates.
They're all storming the gates, and we're going to go back to 20 or 30 offers on a single property. Bid wars, gap coverage, appraisal gap coverage, meaning they're going to whatever the appraisal comes in, we'll pay $5,000 more. All of that stuff. You'll start seeing it come back because the competition is going to creep up.
Yeah.
Supply and demand starts creeping up. Supply starts to diminish. Pricing on that supply is going to go back up. All of that. We're going to end up back where we were just a few years ago. And so if you are looking to engage in the market, you got to acquire a home and all that stuff's important to you. Let's have the conversation now. Let's start the conversation. Reach out to us. We'll dictate or determine where your qualification is at and how much you qualify for. If there's a few obstacles in the way, we're going to let you know exactly what you need to do to remove those obstacles and get yourself on track to qualifying and obtaining home ownership. We'll put you in a loan program that's going to be, meet all your needs, check all your boxes, and the payment, even though it may be a little higher than you're used to, if you can, manage it, then we will certainly put you on a plan to where, we're watching rates, and as soon as rates come back down, whether it's in 6 months or within that 10-year time frame, we have a solution for you. We can refinance. Maybe even at that time, pull a little bit of cash, pay off some debt, or pull out a little extra cash and let you, make some modifications to that home. The options are there, all thanks to home ownership, all thanks to engaging in the market today. So that was
Thank you.
Yeah.
Senior Loan Officer Abel Perez for your
You're welcome.
dropping that knowledge on us.
Just drop.
So,
Drop.
why are you distracting me?
I just dropped knowledge on your head.
Yeah. Okay. So we've gone over beneficiary deeds and rates, and is there anything else you'd like to share after all of that? information?
No, I think we're headed into getting close to getting to spring, right? We're a month closer. It's February now, and in spring traditionally is one of the busier times in real estate. So we talk about those floodgates opening. Naturally, those floodgates will open.
Yeah.
Tax season's among us. People are going to be getting some healthy returns, and that is down payment money. That's
Yeah.
a little bit of ammunition for them to go out there and make their offers a little bit stronger, or qualify for a little bit of a higher amount. And so you're going to see a lot of activity. So certainly don't wait, don't miss that wave, because as prices continue to go up, those monthly payments continue to go up.
So do you suggest people speak to a professional ahead of time, like before spring hits?
Oh yeah, well that's what I mean. Just contact me. Here's my business card. Contact me. I'll reach
short.
out to you, and or we can start determining, like I said earlier, where you're at. If there's any obstacles, we'll nip them in the bud and we'll get you going.
I look like Wilson from Home Improvement.
Well,
okay, well, thank you so much. I really appreciate you.
Yeah, absolutely.
And all of your hard work.
Yeah, I appreciate you as well and all of your hard work. Hey, and we appreciate you guys for watching.
Yes,
please like
thank you.
and subscribe. That's how this channel
subscribe,
will continue to
follow,
grow. Yeah, I think
comment, message.
I don't mean to toot my own horn, but toot, right? Because I think we deliver some great information, a lot of information that you may not know, and most importantly, your friends and family may not know. And so if you share this, you're going to be able to equip them with some great knowledge. You're going to be able to get them thinking, and they're going to know exactly how to reach out to us so that they can qualify and become a participant in home ownership,
Yes.
which is vital to generational wealth to come. This is America.
I felt like I should have said amen after that. Like, amen.
Probably, yeah. Well, this is the MLO Show. Like, subscribe, share with your friends and family. Comment below. Let us know what you think. Let us know your thoughts. We'd be happy to help. Take care.